Good day, traders, and happy Non-farm Payrolls Day. Let's begin and address the Iran-Israel tensions in the Middle East. So very, very late on in the US session yesterday, 2 hours before the close of the US stock market, we had some Twitter news coming out that Israeli authorities believed that Iran was going to respond to the attack that happened on Monday with an attack on Israel on Friday. And this was because it's Quds Day, which is effectively Jerusalem Day. And typically what happens on Quds Day is you get some form of pro-Palestinian, anti-Israeli marches on those kind of days. So there was some sort of a thought process that came out via Twitter that Israeli authorities believed attack was going to happen on Friday. Okay, as a result, we saw some significant risk off, and we'll discuss that on the chart in a minute. But let's just talk a little bit about the news flow and just make sure we understand exactly what has been said and what hasn't been said. Now, coming out this morning, it has been confirmed that GPS is being blocked across large parts of Israel, and this is in order to disrupt any missiles or drones that could potentially be targeted at Israel from Iran. Now, on Monday, what happened, if you don't know, is that there was a strike in Syria on an embassy that killed 13 people, and Iran came out and said they will respond. Okay, so that's this tension has been in the market all week, and yesterday when we got those Twitter sort of sources coming out saying the Israeli authorities believed an attack was coming on Friday, that's when the markets moved. Now, what's important is two things. One, Israel has at no point commented on the targeting of the building in Syria. Okay, they've not confirmed that it was them. Now, why that matters is because typically, Israel always acknowledges carrying out strikes in Syria. Okay, so that's the first thing. They've actually at no point confirmed it was them. And the second thing is Joe Biden came out yesterday and said, look, well, we're aware of the threats from Iran, to Israel, and we stand by Israel. Okay, so in essence, is Iran going to attack Israel when obviously they are effectively attacking the United States? So again, the reason I sort of point this out is take everything with a pinch of salt. Of course, there is geopolitical risk, and of course we need to be aware of it, but also be aware that this has been an ongoing conflict and an ongoing, sort of thing for some time now, particularly over the last 6 months since we had the whole issue with, the attack inside Israel from Hamas. Okay, so what I do want to pay attention to is have a look at the chart. What you can see in front of you there is effectively the proxy market. So what are the markets that are sensitive to this geopolitical risk pricing? And I've specifically put the vertical line there to point out to you, what were the real market movers, what did move, what didn't move. And what's very important as a pro tip, whenever you do see, big risk event moves, always get up the charts you believe to be sensitive to the news and go and have a look and really gauge what are the most sensitive and what are the least sensitive. Because what you want to do as a trader, particularly with risk events, is you want to trade the most sensitive market. Moreover, if you know what the most sensitive market is and there's some form of escalation or de-escalation, you can then capitalize in those most sensitive markets. Okay, so very, very crucial. You must always know what the proxy market is or what the leading market is, because that's where the best opportunity to trade will be. Now, what you can see is in the orange, we've got oil. Okay, it is extremely sensitive to any geopolitical risk in the Middle East, and you can see that did a $2 move. Okay, a really decent move to the upside, pretty straightforward. This is a 30-minute chart, so you can see within an hour and 15 minutes, it did a good $2 move, straight line bid with very little retracement. Now, at the same time, in green, what you see is US 10-year yields, and that only did 5 basis points, and that already should have you scratching your heads, because if it was a true risk-off move, if it was really, some concern of a Middle East flare-up, you would see 10-year do a hell of a lot more than 5 basis points. Okay, from experience, if there is real concerns of a global war or a war that's going to drag the United States in, right, you will see 10-year do 15 to 20 basis points. Why? Because ultimately, everyone's going to run into the safety of treasuries whilst running out of risk assets like we saw in the S&P 500. Okay, so that already is something to be aware of, is that the bond markets didn't respond. Sure, they moved 5 basis points. Sure, it's a big move. But in reality, they they shrugged it off somewhat relative to what oil did. Okay, and that's an important sort of thing to be aware of. The second thing, and if you look at the charts in the yellow, we've got gold, and what you can see is that gold, yes, it bid up initially, but it retraced the entire move. Okay, so gold, not a good one to trade on these geopolitical risks. And then in the blue, we've got the one that was probably the most sensitive, which is the S&P 500, and we can see that sold off 2% into the close. Okay, so the order of things to hit. If you got some form of escalation, if you got a strike today, right, you want to trade the S&P definitely to the downside. You want to trade the oil definitely to the upside. Then possibly also trade the bonds. Okay. That's the order in which you want to trade things. Be a little bit careful in gold. Sure, I think gold will go up initially. But again, we can very clearly see that it didn't quite respond in the same way as some of the other markets. All right, so that's the key markets to pay attention to should there be some escalation. Now, on that note, what I like to do, and a little pro tip, when we do have these sorts of risk event flare-ups, what typically happens is the markets will stay nervous, not for one session, typically a couple of sessions. And when that nervousness begins on a Friday, that nervousness will typically carry over into the weekend. Okay, so what we call that is that sort of that escalatory process. What happens is, there's a threat. That threat sort of, becomes more and more heightened. People are more and more aware of it. People are nervous about it. And if there is some sort of escalation in terms of commentary over the weekend, what you'll see typically on the Sunday night open is you'll see the gap lower in the equities. You'll see some real risk off on the Sunday night. So what I like to do as a trader, particularly today, is I want to try and be short into the weekend, looking for that escalation to happen, even if it's verbal escalation. If it's a strike, obviously there'll be significant moves. But even if it's verbal escalation, we should see some gapping on the Sunday night. Okay, so that's what you want to pay attention to into today's session. Now, that's the first thing. The second thing to look at today is it's all about non-farm payrolls. Okay, what's expected is we are expecting 213,000 on the headline print. That's from 275 last month. The unemployment rate's expected to tick down to 3.8 from 3.9. And then earnings is expected to tick down from 4.3 to 4.1. Now, there's three things to pay attention to today. There's three sort of tradable opportunities I think you need to be aware of. And we'll start with the headline. Okay, looking at the chart I've provided to you in the headline number, what you can see is that we've been stuck in this range of around 150,000 to 300,000 headline non-farm payrolls since the start of 2013. Okay, so to the downside, we can very clearly see that 150,000 is kind of that headline number that should we print below it, there's going to be some significant concerns that we are seeing a significant slowdown in labor. So keep a very close eye on that. Any number around 150 or less, the markets are going to respond with a little bit of a sort of a cuts coming sooner type price action. In other words, bonds up, gold up, and equities we'll talk a little bit about in a moment. Okay, to the upside, what's a good number? What's a number that's tradable to the upside? Well, I think it's got to be above 300,000. And very importantly, why I think it's got to be such a high number. In other words, the expectations are 215. Why do I think it needs to be above 300,000? Well, if you look at what Powell said to us on Wednesday, okay, he spoke to us on Wednesday and he said three things that really, really matter. And he said, look, we need greater confidence that inflation is going to get down to 2% target. And it's too soon to say whether the recent inflation uptick is more than just a bump. The Fed has got some time to let the incoming data guide its policy decision makings. And here's the key. They said recent readings on job gains and inflation higher than expected, but it does not materially change the overall picture of 3 cuts this year. Okay, and that's the key. What he's saying is, yes, of course we've seen, some stronger data from manufacturing. Of course we've seen, inflation tick up, but it doesn't alter our view. Okay, and that matters because what it means is that the bar for getting the Fed to turn hawkish is very, very, very high. You're going to need some significant prints to really get the Fed to move away from this idea of cutting in June. Okay, and that's why I'm leaning on this idea that you're going to have to see a headline number above 300,000 to really get the markets moving in a hawkish type fashion. Now, what do we trade on a hawkish number today? If we get a print of 300,000, where is the trade? Well, US 10-year bonds have been very volatile this week, okay? We broke out of a really key range in the US 10-year, so definitely pay attention to that. We did see some really strong sell-side action in the 10-year in the early part of this week. So any number above 300,000, 10-year is the place to be. And more importantly, that steepener trade we've been talking about, that's how you want to apply yourself. Sell 10, buy 2-year. That is a key trade. The entire Wall Street is putting that trade on. And should we get a number above 300,000, that is going to be a key play for today. In terms of a number less than 150, okay, that makes things very, very interesting. Obviously, gold at the moment is the massive outperformer. So you definitely want to partake in gold. We should see a really good surge to the upside in gold should the number come in below 150. And then again, we want to be focusing on the front end of the US bond curve should we get a number below 150. Why? Because what it means is that June becomes 100% certain for a rate cut, as well as potentially maybe the market starts to bring forward the idea of a cut coming in May month. Okay, so keep an eye on that. That's how you want to trade the headline number. Then the other opportunity, keep an eye on the revisions. Okay, why? Well, because if you go back and have a look at 2000 and 2008, and I've provided that chart for you with the unemployment. What you'll notice is that in 2008, just before we entered the financial crisis, is that unemployment was steadily ticking higher. And then all of a sudden, it just zoomed up the page, okay? And what happened effectively just as, we entered that really significant meltdown in the U.S. economy was that the revisions that came in were quite significant. There were more than 100,000 revisions that came in, and the U.S. economy was already in a recession. In other words, we could be seeing effectively really good headline prints, but they get revised down quite significantly in the following months. And the market, based on what they understood from 2008, will see a very big revision today as, well, in actual fact, maybe the US economy is actually a lot slower and weaker than we expect. Okay, so that's important to understand. Pay attention to it. We got a really big revision last month. If we get another big revision this month, again, market participants are going to start looking at this going, hang on a sec, maybe things are a lot weaker than what we actually think, okay? Finally, the unemployment rate. This is going to be a key to watch today. Why? Because of the SAM rule. If you don't know what the SAM rule is, go and type it into Google, SAHM. The SAM rule basically says when unemployment ticks up 0.5 above the 12-month low, we are typically in a recession. Okay. Now, the 12-month low is 3.4%. Today's expectation for unemployment is 3.8. Should the number come in 3.9 or above, in essence, the SAM rule says we're in a recession. Okay. Now, remember, the market's not pricing a recession. The Fed's not thinking a recession. The Fed says soft landing. So keep a very, very close eye on that. Should the number come out 4%, 4.1, 4.2, don't overthink it. Market participants won't overthink it. They're going to lump into the front of the US market. They're going to lump into the gold market, and they are going to bring forward an expectation of a Fed moving perhaps as soon as May. Why? What did Powell tell us in the last FOMC meeting? He said, look, guys, we have a dual mandate, inflation and employment. Should the employment situation weaken quite quickly, we will not hesitate to respond. Okay, that is the reaction function of the Fed. They will safeguard on both the inflation side and the employment side. So don't overthink it. An unemployment rate of 4% or above, take advantage of that trade. Okay. So that's the non-farm payrolls then for today. And then finally, just one last note. Where do you want to be trading today in terms of the risk markets? Well, look, the S&P 500 chart I've given you, a lot of yesterday's move, the 2% down move, a lot of that was driven, it was initiated, of course, by the potential escalation in the Middle East. But the 2% down move had a little bit more to do with the fact that the S&P was breaking that trend channel. Okay, so there was some stops going off there. That's why the volumes were so high. And effectively, we've now broken that trend channel in the S&P 500. So what is the S&P going to do today? Well, look, the VIX, as you can see in the blue line, is trading above 15. We're trading at the high of the year. We've had the S&P break that trend channel. So technically speaking, the S&P is weak. Fundamentally, we've got some sour sentiment with the Middle East escalations. Sentiment is weak. The VIX is 15. That tells me the S&P is a sell all day. Sell rallies today. Don't be afraid to short the S&P at some point today. And what that makes me think is that non-farm payrolls, you want to be very, very cautious buying the S&P today. Okay? The way I suspect it, should we get a bid up on the non-farm payrolls, I'll be happy to sell that. So keep a very, very close eye on that. Levels to keep an eye on the S&P, I think 52.40. That's a really key place to pay attention to. That was the Tuesday low. That is where the market sort of defended itself, both Monday, Tuesday, Wednesday. Keep an eye on that 52.40. We test that today. That's where you want to be getting short. All right, guys. Most importantly, take care of risk today. It is a risk event. Manage that risk. Make sure you know where those stops are. Use the application. Make sure you can get the right position sizing on. And last of all, good luck and go make some money.